Financial markets are not static systems. They behave as fully dynamic, non-linear systems. The main force that creates this complexity is the fact that trading orders, such as limit orders, stop losses, and trailing stops, do not remain where they were originally placed. They move and adjust in real time. Because these orders shift as the price evolves, they continually change the boundary conditions of the system. This makes the market dependent not only on price, but also on time. In dynamic systems, behavior is determined by three core variables: price, time, and initial conditions. In financial markets, these initial conditions are not only the previous price levels, but also the live positions of all standing orders. Since those orders are constantly adjusted, the starting point of the system moves with time. This is what makes the market nonlinear. A small modification in an order's position can produce an entirely different outcome, similar to a small change in initial conditions inside a chaotic system. Mathematically, this resembles a system defined by an update equation of the form x of t plus 1 equals f of x of t, comma t. This means that the function is dependent on both the current state and on time itself. In the market, this function represents the shifting fields of supply and demand created by dynamic orders. When a trader moves a limit order upward to chase the price, he effectively shifts the demand field higher. When stop losses and trailing stops move behind the price, they create a changing gradient of selling pressure. This behavior aligns with systems in physics where forces evolve in time rather than remain fixed. From this behavior, fractality emerges naturally. A pivot point is not just a price reversal. It is the creation of a new set of initial conditions. A pivot contains two critical values: the low of the pivot candle and the low of the candle that follows it. The ratio between these 2 points defines the initial slope of the trend. This slope is not a visual line on a chart. It is the mathematical relationship between price movement and time. This echoes the geometric logic that Gann explored, where trend angles represent proportions between time and price. More formally, if delta P is the change in price and delta T is the change in time, then the angle of the trend is given by theta equals arctan of delta P divided by delta T. When dynamic orders shift the pressure zones, delta P over delta T changes. As a result, the trend angle adjusts. This is the foundation of fractal subtrends that form inside the primary trend. When the ratio between the two starting points changes, the equilibrium point of the trend also shifts. This is similar to how the center of mass of a mechanical system moves when a weight changes location. In the market, the accumulated order flow acts as this mass. When traders reposition orders, they move the center of equilibrium of the trend. This is what creates what we perceive as trend breaks or reversals. It is not random. It is the natural outcome of changing boundary conditions and changing angles derived from them. When the boundary conditions are temporary and constantly evolving, fractals form and expand according to the structure of their initial conditions, in a way similar to logistic growth equations and other nonlinear dynamic systems. For this reason, trends are not arbitrary lines and not graphical predictions. They are geometric structures that arise from the interaction between time, price, and the continuous repositioning of orders. This is the mathematical and mechanical foundation behind what Gann described as the relationship between price and time, explained without symbolism and grounded in dynamic system behavior.